Overview of Venture Capital VC. Venture Capital VC is a form of private equity financing provided by investors to startups and early-stage companies that are believed to have high growth potential. It typically involves the exchange of capital for equity in the company. Venture capitalists are often actively involved in the management and strategic decisions of the companies they invest in. Key features: 1. Focus on innovation. VC funding often supports businesses in high-growth industries, like technology, biotechnology, and clean energy. 2. Risk and reward. Venture capital is inherently risky, as many startups fail. However, the rewards can be substantial if the company succeeds. 3. Stages of investment. VC typically occurs in stages: seed funding, early stage, growth stage, and later stage. 4. Equity stake. In exchange for funding, venture capitalists take a percentage of ownership in the company. History of venture capital. Origins 1940s to 1950s. 1. Post-World War II development. The modern VC industry began in the United States in the mid-20th century. 2. Formation of institutions. 1946. The American Research and Development Corporation (ARDC), founded by Georges Doriot, is considered the first venture capital firm. ARDC's notable investment in Digital Equipment Corporation yielded massive returns. Wealthy families, such as the Rockefellers and Phipps, also invested in startups. 1960s to 1970s. 1. Shift to Silicon Valley. The rise of Silicon Valley as a tech hub drove the growth of venture capital, with firms like Kleiner Perkins and Sequoia Capital leading the way. 2. Tax code changes. The Small Business Investment Act 1958 and changes in capital gains taxes spurred the growth of VC by incentivizing investments in small businesses. 3. Tech boom. Early VC-backed successes included Fairchild Semiconductor, which laid the groundwork for Silicon Valley's dominance. 1980s. 1. Explosive growth. The industry saw a surge in activity due to deregulation, economic growth, and increased awareness of VC's potential. 2. Institutional investors. Pension funds and endowments began investing heavily in VC funds. 3. Famous IPOs. Companies like Apple and Genentech went public, showcasing the financial potential of venture-backed startups. 1990s to 2000s. 1. Dot-com boom and bust. The Internet revolution fueled a frenzy of VC investments in the late 1990s. The subsequent dot-com bust 2000 resulted in significant losses for many investors. 2. Resilience and recovery. Post-2000, the industry refocused on sustainable business models, with companies like Google and Amazon demonstrating long-term growth. 2010s present. 1. Tech dominance. Venture capital has been instrumental in the growth of major technology companies like Facebook, Uber, and Airbnb. 2. Global expansion. VC has expanded beyond the US with significant activity in China, India, and Europe. 3. Rise of mega funds. Larger VC funds, such as those managed by SoftBank, have changed the dynamics of the industry by making massive investments. 4. Diversity in funding models. Newer funding mechanisms, like crowdfunding and corporate venture capital, have emerged. Current trends in venture capital. 1. Focus on AI and clean tech. Startups in artificial intelligence, renewable energy, and climate tech are attracting significant VC interest. 2. Decentralization. While Silicon Valley remains prominent, other hubs like Austin, Bengaluru, and Berlin are growing. 3. ESG considerations. Environmental, social, and governance ESG factors are increasingly influencing investment decisions. 4. Micro VCs and angel investors. The rise of smaller, niche-focused funds complements traditional VC firms. Venture capital continues to play a pivotal role in driving innovation and economic growth. adapting to global and technological shifts while shaping the future of industries worldwide.